Good morning, all. Tuesday, July 26th. Great show in store. Mr. Stock Trader Almanac himself. His real name is Jeff Hirsch. I wonder how many people in this room, Jeff, actually don't know who you are. They know your product, but they don't know who you are. We got to fix that. So I'm really looking forward to this room. It's been a few days. I think last Thursday. We've kind of settled into this Tuesday, Thursday, midweek, 11 a.m. rhythm. I'm open to suggestions as to when we should do those, in particular time of day. There are puts and takes with every time you can think of. Some would say 11 a.m. is too early in the day. I know people on the West Coast, like Aces, don't want to get up that early. Well, too bad. The other side of that, I have no sympathy for that. But the other side is I do have sympathy for our European friends who, if we start these spaces at 4 or 5 in the afternoon Eastern time, it gets late their hour. And certainly if we do them in the evening, it gets late. And so maybe we mix it up a little bit. I don't really know. If anyone has any suggestions as to the timing of when we should do these, days of the week, time of day, please let me know. Always trying to make these spaces better. I think we do have the best spaces on Twitter, period, but that's just my opinion. And judging by all the DMs I get from a lot of you folks, I think you agree with that. Just listening to the lyrics, that was, for those of you, Hirsch knows who that was. That was ELP, Emerson, Lake and Palmer. That's back from the 70s. For those of you that weren't around back then or aren't familiar with that band, one of the great bands of when I was growing up. But it's hilarious. I'm just looking at the lyrics here. The name of the song is From the Beginning. It wasn't their best hit, but it was one of my faves. And I'm just looking at the lyrics here. I'm sorry, I can't keep it together. It's so appropriate. I mean, maybe this should be Ode to Jim Cramer. It says there might have been things I missed, but don't be unkind. I guess they're talking about me. I don't mean to be blind. Perhaps there's a thing or two I think of lying in bed. I should have said, but there it is. You see, it's all clear. You were meant to be here from the beginning. Maybe I might have changed and not been so cruel, not been such a fool. Whatever was done is done. I just can't recall. It doesn't matter at all. You see, it's all clear. You were meant to be here from the beginning. So with that, you can tell that I don't have a very good voice. I'm not meant for singing, but it's hysterical. I go back and I look at the lyrics of a lot of these songs. It's just, I can't keep it together. So a few points to rant on before we get going. Every day is something new to talk about. I'm just looking at some notes I jotted down here, not in any particular order, but things that catch my eye. Towards the end of last week, the close on Thursday, everyone's, after we just got this is the first time in a million days we're above the 50-day moving average. You're saying there's a chance, blah, blah, blah. XYZ doesn't go down on a given day or a given week despite crappy earnings, so the bottom must be in. Everyone piles in. The shorts go tripping over themselves to cover their shorts. You can see it particularly in the most heavily shorted names, the likes of Carvana. There's no more motivated a buyer than someone who's short. Trust me, been there, done that. And so you had a lot of short covering. People not really getting long, though. And I'll come to that in a second, but it's a great chart. I'll put some of these charts up on my Twitter feed, Jeff is talking. But I think just go to it here if I can find this one chart. It shows that basically hedge funds have been degrossing. That is to say, they're taking down both the long and the short side of their book. So they're puking longs, but when they're covering shorts, particularly in the crowded names, that's what gives you the squeeze to the upside. So degrossing, back in the day before you had a preponderance of long short funds, when people would degross, they'd sell longs, market goes down. Now when they degross, they take both sides of the balance sheet, they sell the longs, and they cover their shorts. It's nothing more annoying than in a flat market or in a market slightly going down or slightly going up, having your shorts ripped to the upside in your face for no other reason than there's someone caught on the wrong side who's just trying to degross. And then people try to ascribe meaning as to why that stock is going up. And actually, I see we got John Roque in the second row, and I really, John, it's been a long time since you spoke. I hope if you can shake free from your real job. Maybe you can weigh in on this a little bit. But you look at the Goldman Sachs index of most heavily shorted names, that thing was skying for a couple of weeks. And, maybe we've seen peak squeeze, don't know. But I guess the bigger point I want to make is nobody really knows. And if you try to ascribe meaning to daily or weekly movements, that's just going to get you in a lot of trouble. Which is why always in this room, I'm always saying I'm trying to get the intermediate to longer term. I say long term, I don't mean, 5 years, and we're all dead 5 years from now. I'm talking about the next few months, not the next few days, or in that case, sometimes weeks. I leave that to the likes of Tommy Thornton, who's done just a fabulous job in bottom picking, bottom fishing. So, but at any rate, so you had this move up for a few days. People get all amped up. So you're saying there's a chance. And, just when it looks like it might go north, what happens? The trapdoor opens on Friday. And then yesterday was a bad day, particularly in the toxic Kathy type stuff. And then after the close, we had Walmart. Anyone who was surprised by Walmart, it's like one of those Hitler videos. Anyone who was surprised by the Walmart numbers needs to get up and leave this room now. I don't know how many times we can talk about how the consumer is totally screwed. So, this is the second blow up they've had in a few months now. So this should come as no surprise. And the XRT, the retail ETF, which is again, one-stop shopping for all your unnecessary purchases, that thing's getting destroyed. I think it's going to go down a lot more. John Roque had it in his chart pack a few weeks ago. I recall John was looking for new lows in XRT, which would put it at 50, which is right now at $60.70. So consumer remains front and center. All the stuff you're seeing on CNBC and Bloomberg TV, you've been hearing about it in this space for since the beginning of the year. So if it sounds like I got an edge in my voice, it's because I do. I don't know, these knuckleheads are asleep at the wheel. Like, what were they thinking? What were they looking at? Don't want to be a dick and say, I told you so. Don't want to take a victory lap. How to take a victory lap without taking a victory lap. That's what some wise guy was going to say. They'll tweet right back at me. But seriously, dude, come on. Let's call a spade a spade. The theys have been completely wrong. The consumer's in fine shape. Never underestimate the consumer. Are you kidding me? The consumer's never had his real incomes getting eviscerated like he's been having it now. So like I said, going back to the beginning of the year, go back and, and there was that podcast I did with Jack Farley of Blockworks. I said you can do one or two choices. Either they do what you need to do to get inflation under control and have a recession, and you can kiss your earnings goodbye, and good luck with your stock market, or they don't, and inflation just keeps cycling upward. This idea that we're going to have a soft landing, put it another way, the recession will not come down adequately. I'm not saying it's not going to come down, but it's not going to come down sufficiently to the levels that they want without a recession, without jobs being lost. The economy's overheating. The economy has overheated. We've got a record number of job openings. If anyone in the Austrian school, my friend Nathan, maybe someone wants to come up and talk about the Austrian school, this is classic. We've run out of factors of production, ran out of labor, ran out of energy. The economy's overheating. Period. So this is not going to change to the extent it needs to without a recession. That's my 2 cents. A couple other graphs, and we're going to go to Jeff. There was a blurb out the other day, Redfin. I'm looking at these charts. I'll put them all up on my feed. And again, thank you for those of you that reached out to me. If you're interested in the deck I put together a week or two ago, just send me a DM and I'll send it to you. It's got a lot of good charts in it. Record number of percentage of houses that are experiencing price cuts in offerings. It's at 7%, I think, now, as of like a week ago. So look at the graph. It's if Roque was or Nikoski was looking, this was a stock, he'd be buying it. This is the graph of percentage of homes experiencing price cuts. This is up and to the right. This is a good chart. Bitcoin, it's hilarious. These guys, the trend is down and to the right. Every time it like a dying man, on his last breath, it puts its head up a little bit, the crazies come out again. Like, I don't know what it is they're looking at. I mean, Dennis Gartman, please call your office. Do more of what's working and less of what's not working. Buying Bitcoin is not working. Let's see here. What else I got for you? Earnings. Yeah, earnings are coming in. It depends. I love this nonsense. Oh, it's better than expected, worse than expected. They game the whole system. They set the bar really low, and then they beat it, and they want to take a victory lap. And then you have the cheerleaders on CNBC saying, "See, well, let's actually look at year-on-year earnings." And as the great Michael Belkin has pointed out repeatedly, earnings are going down. I mean, if you back out energy, earnings for the whole market ex energy are actually falling now, not next year. Now, so the cheerleaders are going to have to explain to you on that one. Remarkably, consensus estimates for 22 and 23 really haven't come down at all. Let's see how long that lasts. Sentiment, fear and greed got up to 39 the other day. I don't know where it was yesterday, but in a bull market, don't expect it to go up to the stratosphere. Quite often all you'll see is 30 or 40 or 50, and that's it. Duration of the bear market, again, I'll put these all up on my feed, and this is the type of stuff I put on my chart pack. This bear market, while it's hurt if you've been in the wrong stocks. In terms of duration, it's very young. In terms of the S&P, which really hides the extent of the decline of the average stock, S&P only peaked at the turn of the year, so only a few months into this, and the market itself is measured by the S&P, which again hides the real damage going on, only down 20 some odd percent, which is small compared to the average this past century, the 41%. So there's a lot more way to go in terms of time and price. Mentioned hedge funds exposures, they've been degrossing. Curiously, though, as a Morgan Stanley blurb from the other day, that because of short covering, in other words, they were covering more shorts than they were buying than they were reducing longs, their net long exposure actually went up. It got up to 44% net long, which is still low in a longer term context. But again, as the market's going down, these funds are getting longer. Not quite what I would suggest. Cyclicals are assuming the worst. The internals of the market are telling you it's going to be bad. Defensives, relative valuation though, is through the roof, and that's where the money is flowing. So maybe the consensus positioning on that will be right. And then lastly, I'm looking at a JP Morgan graph here. This is out of date, but you get the idea. It says here, it just talks about the hedge fund, the short covering. JP Morgan saw a sizable covering over the last week. The U.S. high short interest stocks through the 5 days through Thursday of last week were up 12.5%. 12.5%. It's one of the largest 5-day gains over the past year. So you're saying there's a chance. All right, enough of that. So we go to the man of the hour, my friend Jeff Hirsch. I've been a secret admirer for a long while. We've actually only met a few months back at the CMT conference in April in DC, where our good friend Helene Meisler, and I'll try to get Helene to come in here. Jeff, maybe she can throw you some softball questions. I'll throw you some softball questions. In any event, I've really enjoyed getting to know Jeff and reading his stuff. Really sharp cookie. I like the fact that he's pretty flexible and he's respectful of the market. He combines fundamentals with technicals, which is the way I think you got to roll. I think to do one at the exclusion of the other, it just doesn't work for me. I'm not going to comment on other people, but it just doesn't work for me. I think you got to have a holistic, fully integrated, whole brain approach to investing. And so for that reason, I like Jeff a lot because he's not dogmatic. He uses common sense. And you all are probably familiar with Stock Traders Almanac, which was a publication, I believe, started by Jeff's father, but I'm going to let Jeff talk about that. So in any event, Jeff, I'm really glad that you're here. Maybe it'd be a good place to start. I think what we could do here is I want to yield the floor to you. Good place to start. Just talk a little bit about, what you do, how you got to where you are, and then once you're done with that, get into, what really catches your eye. What are high conviction views on your part? You may be agnostic on the market. Maybe there's a sector you like. Maybe there's a stock that you like. I don't know. But, in what's really a sort of differentiated point of view for you? What do you believe that the market doesn't believe? Or what does the market believe that you don't believe? Jeff, without further ado, the floor is yours. Welcome, Jeff.
Well, thank you, Ron. It's a pleasure to be here. 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 It's a George, such a pleasure. It's been great getting to know you. We've had a lot of fun chats, a lot of informative ones, and I got to tell you, coming on and hearing from the beginning was just a big smile. Um, because my older brother, turned me on all that stuff. He's about 10 years older than me. I was, you know, elementary school age in the '70s. He was in high school and stuff. But um, super fantastic. Uh, Seems to make sense with the Almanac, with the history that we, have written about and rely on for years. So it's I think I was definitely meant to be here. Um, I want to get into a little history, but my father, who we just lost at 98 in November of last year, is an icon on the street. Everyone knows the Almanac. I had the pleasure of learning at his feet. Just while just basking in his tutelage. I basically fought working for him for many years, and was into other businesses back in 1989 when my good friend looked at me and said, "Jeff, what are you doing? Go work for your father." So I did. Luckily, I had grown up in the business. Basically, started in the mailroom, shipping almanacs out to brokers and doing a lot of numbers by hand. You and I have had that discussion about doing things by hand, and uh, hats off to Helene Meisler for bringing, over 120 or so sheets of graph paper and 120 number two pencils to the CMT symposium and teaching everyone how to draw hands, draw graphs by hand or charts by hand. I started doing the almanac calculations back in, uh, middle school, high school, with his little short ruler running down the market lab pages with a red pen underlining up half hour ticks and then entering them into a sheet of graph paper using an adding machine. So we are still very fond of doing things by hand. You get to see a lot more. Even the stock screens that we do, it's not a macro that we punch in. We sort Excel spreadsheets and watch things fall to the bottom and see what's going on there. So basically, 56 years on the street with the Almanac. Um, Put a couple other things out there. One of the great long-term cycles I learned from Yale was this super boom cycle, the 500% moves following war and inflation, which he put out a forecast in '76 and culminated it in a special report in January of '77 for a 500% move off the December '74 low for Dow 3420 by 1990. Missed it by just 2 years on the Dow. The S&P did hit it in '90, but the Dow crossed it. We have a little clipping of that in '92. And my Super Boom book I put out in May of 2010 with Dow around 10,000 for this move to 38,820, the same 500% from the 2009 intraday low. Put a lot of people off guard, and I know we're in a bear market here, and we're both a bit bearish. You're probably a little bit more bearish than me, but that long-term forecast is a testament to the cycle work that we do, and even the incredulous reaction we got to it. I'm reminded of my 22 Stocks Traders Almanac Outlook, where I quote the blood, sweat, and tears classic track spinning wheel about what goes up must come down with our outlook term year. So we've been expecting a lot of this with our seasonal and cyclical work. I'm going to give you a couple of thoughts. Our basis is cycles, seasonality, history, and yes, as you said, into fundamentals and technicals. I just passed the level 1 of the CMT. Never too late. We look at internals and sentiment, highs and lows and advanced decline lines, and some of the forms in the back of the almanac are really geared towards keeping track of these types of patterns or these types of indicators. There's a weekly indicator section where you can put in whatever you want. There's also suggestions on the changes of on Mondays and Fridays to put call ratios, highs and lows, advanced declines. So that's ingrained in the almanac cycles and patterns and analysis. We always have an eye on geopolitics and current events and monetary policy and sentiment, of course. We could have a discussion about the put call ratio, which I am finding is less and less indicative. We also look at investors' intelligence, bullish and bearish advisors. Seems to be a bit more consistent there. It's been around for a while as well. I know there's lots of other other sentiment indicators that people look at. But for the most part, we sort of take a big page out of the quote from Santayana that those who fail to remember the past are condemned to repeat it. I like to think that those who study market history are bound to profit from it. And that's what we do. There's a couple of we were talking the other day about the wisdom of the elders, and there's a quote that I've been carrying out, and this is based upon our a takeoff of the seasonal work that we do. Everyone wants to associate sell me and go away with us, but Yale invented the best and worst 6-month switching strategy in 1986, which is not a go away situation. It's changing and repositioning your portfolio with respect to the market, making most of its gains from November to April and going ways to October on average in most years. This is a quote. You remember a guy named Edson Gould? Contrarian did a newsletter called Findings and Forecasts.
Yeah, Jeff, 100%. As a matter of fact, Walter Deemer was talking about Edson last week when we had him in the space.
Oh, Walter's another one. He is somebody I'd like to get to know even better and spend some time chatting about stuff. So the Gould quote, and the Almanac is full of quotations. I curate them. My father did it, and I'm always looking for suggestions for that and everything in the book. We take a lot of input from readers as you do also for the space here. But the quote is, if the market does not rally as it should during bullish seasonal periods, it is a sign that other forces are stronger. And when that seasonal period ends, those forces will really have their say. Well, best 6 months got crushed this year. Really began to bring our worst case scenario. We do a newsletter forecast in December, just before the Christmas break, before the third, the triple witching day in December, and we were also we put out a few scenarios. I'm not calling the exact level of the market, 12 months out, but we do a best case, base case, and worst case. Our base case was for things to not be as bad, but as the January barometer, which is another thing Yale invented, came in negative, and we started seeing things break down. We started leaning towards our worst case scenario. Actually, from our July newsletter was worst case scenario in play, no bottom yet, and that was a June 30th date. So the other thing with bear markets, you probably don't know Dan Turov, guy we used to do a newsletter with, been around for a long time. And this was a quote about bear markets that he put out back in the 2000, bear. That bear markets don't act like a medicine ball rolling down a smooth hill. Instead, they behave like a basketball bouncing down a rock-strewn mountainside. There's lots of movement up and sideways before the bottom is reached.
Hey, Jeff, that's a money quote. Whose quote was that again? That's awesome.
Dan Turov, good friend of mine.
Okay.
He's out of San Diego. I used to publish his newsletter. Then he took it back, took it out on his own. Dan's a real sharp guy. He does a market timing system, and that's, these things jump out at me as the market does what it does. And we've had a very cautious scenario going forward. I'm going to get into some things I'm looking at and some comparisons out there. But we do carry a stock and ETF portfolio, a couple of ETF portfolios. We have a small mid cap and large cap stock portfolio, sector rotation ETFs, and then our tactical switching strategy. And everyone's wrong a lot. There's a quote from Red Holtz out there that I'm not going to remember offhand, but basically, most of us are wrong a lot. The point is to recognize the error, honor the stop, sell the position, and move on. And we watched our portfolios, from February through, May, just weed itself out of positions. A lot of them were stops that were raised up that were taken out for profit. Some of them were ones that didn't work, but we've got cash as a position listed in our ETF portfolio. And I had an advisor call me the other day asking me he was going to go talk to his investment committee. And before they went out to clients, is that really cash? I'm like, yeah, it's cash. It gives you time to think.
and Jeff, give me a chance to catch your breath. I went up for 1 second. So I was in a space a couple of weeks ago. I was a listen only mode. And it was a space at night. And there were a bunch of these RIA guys. I felt sorry for them. and they were talking about the pressure they're under at these major firms to keep the money invested. So if they have too much cash, the Gestapo calls saying, "Hey, what are you doing?" Or if you sell something, what are you doing? And I was listening to this. I was like, to me, I mean, I could just chuckle listening to you talk. That was just such a tell listening to these guys. I mean, it's signs of the times. Yeah, as you rightly put it, cash as an asset allocation decision. So I just had to weigh in on it. Go ahead,
Oh
go ahead,
yeah,
Jeff.
of
Yeah.
course. It's not long term; it's temporary. Um, I mean, getting into the cycles and other information you were mentioning about soft landing and stuff. I mean, we look at the GDP now. I'm sure everybody does. I mean, it's pretty much already a foregone conclusion that we are in the typical two down quarter. Two quarter
No, no, no,
reduction.
Jeff, you're not watching TV today. It's like when you're watching a ball game. After a careful review of the play, and they went to the referees in Secaucus, New Jersey, NBA. No, they ruled while the foot might have been on the line. It actually doesn't count. It may be a technical recession, Jeff, but it's not a real recession. Sorry.
No, that's okay. I actually have it on mute, so all I see is red across the bottom right now. Yeah, they may say so, but you can feel it out there. So we got that going for us. We've got some positive seasonality. Short term here, the turn of the year, we're seeing that fade. You can look at my Twitter feed or the website or blog, and you'll see some of these charts of the typical July. We've got a analysis. We'll see where the month ends if it can hold on to this. But hot Julys, and I'll probably put this out, are notorious for creating better buying opportunities later in the year. So if this market stays where it is and doesn't give it all back, it's a recipe for another downdraft. We're also in this weak spot of the 4-year cycle, one of the few cycles that has a particular time frame that I believe in. We're the only country on the planet, or at least developed one, that has a regular election every 4 years for the leader of the country and every 2 years for the representatives. There's no votes of no confidence and et cetera and so forth. And this creates this regular pattern where the third year of the cycle, the pre-election year, is the strongest. There's been some shifts with election years becoming weaker as mudslinging lasts longer and goes further. But this third year is still notoriously the best year of the cycle, up double digits depending on the time frame you look at. And what we've found, looking at a quarter by quarter basis, is something called the weak spot of the 4-year cycle. Which, guess what those two quarters are? Q2 and Q3 of the midterm election year, what we're sitting, smack dab in the middle of. But this sets up the sweet spot, and this is one of the reasons why I'm not as bearish as some out there for a little bit further out, for the 6 and 12 months out, where you see in the weak spot the Dow averages a loss of 1.2, S&P 1.5 loss, Nasdaq minus 5%. Yes, we've overtaken that by a lot. But the sweet spot of the 4-year cycle is from Q4 the midterm year to Q2 of the pre-election year, and the pre-election year still does well through the end of the year, and it's a 19.3% gain for the Dow on average, going back to 49, and 20% for the S&P, and then since 71 for Nasdaq, 29.3%. And this is one of the reasons that my father dubbed the term midterm election years where bottom pickers find paradise. We've been keying on this cycle, and it even matters more that the market is trending in this direction of the cycle. It's sort of the convergence of the 4-year election cycle and the seasonal, monthly cycle, the best and worst months of the year. And, the chart in my outlook in the 22 Almanac was midterm election year seasonal patterns compared to all years, first term midterm years, which presidents seem to get a bit more of a run for their money, and then Democratic president midterm years, and then the second year of new Democratic presidents, which is basically the first midterm year of a Democratic president. And 2022 is tracking this trend wise very closely. We've posted this chart. We update it almost monthly. And the good news is that this move from the midterm low to the pre-election year high on average is about 47% for the Dow going back to 1914, and on NASDAQ from the midterm low to the pre-election year high, an average gain of 68.2%. And the interesting thing to me is that the bulk of these lows occurs in October, and the bulk of the highs occurs in December, and many of them on the last trading day of the year. So while we sit here and look at the negative, and I don't think we've hit bottom here yet. I've been saying that we're looking at neither the end of the bear in time nor level. But I sense it's coming close, and I wouldn't be surprised if we saw a low point just ahead of the midterm elections or thereabouts, maybe even next month, September, the two worst months of the year. And then that brings into question the midterm elections, which up until Roe, it was pretty much almost a shoo-in that the Republicans were going to take back the House and possibly and more likely even the Senate at that point. Now the political calculus has changed a little bit. But if the Congress flips, and everyone's always talking about what party's better for the market, and they're always referring to the White House, it's really Congress that matters because they hold the purse strings. So the best combination politically, the best political alignment combination for the stock market has been a Democratic president and a Republican Congress with an average gain of 16.4% in the Dow going back to 1949. It's going to take some maneuvering out of the White House, some tacking to the center, as Bill Clinton did back in 1994. And then I think, the previous time we had some of that work. This was with Ron Reagan in office, working with the Democrats on the other side, especially Tip O'Neill. And it remains to be seen if that's going to happen. So some of the other comparisons that we're looking at, the 70s and have been come into play with stagflation out there. We're running a chart looking at 2022 versus 70, 74, and 1962, all midterm election years. And from about April through, mid-May, 2022 was on the exact same path as 1970, which we had that May 26th bottom, in the midst of, Vietnam and protests and, 4 dead in Ohio and all that stuff. And, all of these 3 years have either a test of this early year low out in October or even a lower low. Look at 74. I know there's some think out there that we're in a 1973 type situation, but we're also in a midterm year, and we've got a declared bear market, whether you look at the Ned Davis research rules, which I do, or the 20% rule. No matter how you slice it, it's an official bear market. So we went back and we took all the official bear markets as defined by Ned Davis research, which is in the Almanac on page 130 something, if I can remember, if you've got one handy, 133 and 134. And there's about 19 of them. There's a few that we didn't include, these 30% reversals in the value line geometric, 87, 90, 98, and 2020, which were sort of just short event driven bear markets. And the math is that, after you hit that official 13% down to 145 days, the average decline at the bear market end is 25.4%. This is Dow based, an additional 12% drop. And the days that it puts it out are another, 6 months or so, 139 days. And that puts us at October 31st with the projected low on the Dow of 26,732, down 26.4% year to date. And we have a chart that shows 22 Dow, S&P, NASDAQ with all of those midterm years, a composite chart. So that's kind of where we're thinking in general. I could go on. if you want to chime in, we
No,
can.
that's great, Jeff. I mean, you covered so much ground in a short period of time. A lot to dig in there. Let me throw a few questions at you, and then we'll get some others up here. I see we got Porter in the house, Roki's in the house, Kowski's house, Carpathia. Great lineup as usual. So let's talk about one thing. Many things you said caught my ear. One was, and maybe tease us out a little bit. One was when the market doesn't do, or something doesn't do what it's supposed to do, or at least what historically would do, suggested by the percentages in the past, that's noteworthy. Could you, so like when the market's supposed to
Yeah,
rally and it doesn't rally, could you talk about that a little bit more? Because I think that's a really interesting insight.
it is, and I've spent a bunch of time talking with others about it. Our friend JC Peretz, another CMT guy from All Star Charts, he and I have had discussions about, when seasonal patterns don't work, they become indicators. Um, and this is something that came out of a conversation that we had. I mean, it's basically you're looking at something that's got a scientific method proof, where it's the null hypothesis has been disproven, and there's a year where or a time frame where it doesn't happen. So if you're seeing a consistent manifestation of behavioral finance or human behavior with their money, that's reflecting the stock market, something else is at play. There's another force that is overriding the general pattern of how humans behave, and that's what we were seeing in 08 09 or 07 08 08 09. Same thing that happened back in 72 73 74 and 70 72 73 73 74, where you had these back-to-back years of down best 6 months, with the as I call the buy in October, get yourself sober period, instead of the sell in May and go away period. And that's what we were witnessing here in April, at the end of April in 2022. And that's a red flag and an indication of itself that when seasonality, a consistent seasonality like that, doesn't work, something else is going on.
Jeff, another question of similar ilk. One of the things I notice is increasing misuse of technical analysis and sentiment.
Mm-hmm.
This one of the words that I'm really triggered by is democratization. Whenever I see an ad from Robinhood or whatever, the democratization of markets, you can do this yourself. Like I tell people, run, not walk, as fast as you can away from that. And what you do, what Helene does, what any serious practitioner does, I mean, it's not, you don't just get out a ruler and some crayons and memorize Fibonacci 0.618 and we're good to go. I mean, it takes years and years of experience and pattern recognition. And, this you can do it yourself, E-Trade mentality, like people just blowing themselves up because they're being led to slaughter by the likes of Jim Cramer and others. And so, as you observe in your years and you see how sentiment and technical analysis is increasingly used, or shall I say misused, I think it's a real problem for a lot of individual investors. And maybe I'm being too negative, as is usually the case. But as you look around and you see how, like the sell side, for instance, there are very few major houses that have technicians anymore. The flip side of that is you can go in FinTwit and there are all these kids with baseball caps on backwards, for $99 a month with their Discord service. They're telling you how to, blow yourself up in 3 easy steps without even trying. So maybe it's by dint of some of the questions you get from your readers or just things that you see. But any reflections on how people are misusing data in studies? It's sort of like, remember the old Sims commercials when educated consumer
Is our
is
best
our
customer.
best customer? Sometimes little knowledge is worse than no knowledge. What would you say about
Is that the same guy who did the Carvel commercials?
that? We're dating ourselves, dude. Go ahead.
Sorry. Yeah, I have a recent quotation from a CMT, you know, legend Ralph Acampora. Before I give you that, I mean, it's similar to me to the whole information overload we have in everything. I think technical analysis has been used well by a few. I think everybody out there is not making a fortune doing it. I see some small traders that I know, friends and such, go back and forth and struggling with it. I see some people that have some success with it. So Ralph's quote, which I think grabs this, is analyzing the chart is the easy part. Actually doing what the chart says, that's the tough part. Um, People are emotional beings.
Wait. You mean I'm not the only one who sees a chart that's opposite the way I'm supposed to be, and then says, "No, Jeff, you got it wrong. Turn it upside down."
It's like the break on a putting green. What? That's going right. I thought I was going left. But there's times where I wish, or and sometimes use a trader or a broker to execute my own analysis to get my own emotions out of the way. My business partner, thankfully, is much less emotional than I, um, and it's a nice fit. But I think there's a lot of hype out there. There's a lot of marketing, whether it be doom and gloomers, or you can be a successful trader for just 1 hour a day. Those are people that are selling information. Granted, I sell information also, but I'm not always telling you to buy or sell something, as we previously mentioned with the cash position. So I think there's definitely an issue with overuse and misuse of technical analysis. And then there's the indicator graveyard, which is hard to be, the mortician on that, which is something that Yale came up with years ago. That we are constantly looking for things that are no longer working or new things that are happening. And I mean, I benefited from being around as some things evolved and changed. There used to be a September reverse barometer, because there was a whole different concept about people getting back in, coming into the market after the summer, and that just fell by the wayside, where it was no longer an indication of what the market was doing. It probably came around in a bear market period of time when stocks would go down in September and then rally in the fourth quarter. It doesn't work the other way.
Hey, Jeff, let me interrupt you. You talk about the indicator graveyard. I love that one. So,
Mm-hmm.
indicator graveyard. So, things that I observe in recent months that trigger me, and I think there are a whole bunch of people out there who they're bloviating about this indicator and that indicator. A lot of noise, but not much information. In other words, the signal to noise ratio is incredibly low. So, for instance, you mentioned the put call ratio a minute ago was kind of having
Yeah.
a lot. Okay. I also look at sentiment. Okay. There's so many polls. And one of the things I observe just standing back is people spend so much time worrying or trying to measure what other people are saying rather than just doing the work on the company itself. In other words, it's like the Keynesian beauty contest. It's not who's the most beautiful girl, but who do you think the judges will deem to be the most beautiful girl? And
Mm-hmm.
it's like polls of polls. It's just like it's out of control. And then it's made worse because you had the proliferation of volume in options markets like you've never seen before. And so going back to the put call ratio, the options data, it's like I'm not sure what it's measuring. Um,
Exactly. Yeah. We
and also, I want Roke to come up here because John, if he can speak, I don't know if he's busy, but when you think about he's made some really insightful comments. And Guy, maybe you can come up here as well, or Newman, about in a market where you got increasingly dominated by machines and algos. I remember John telling me years ago, for instance, take right now, it's a perfect one. I'm going to try to channel my inner John Rook. Yeah, everyone's looking for the capitulatory bottom, the puke, the cathartic, get me out, dump, all right? But as John told me years ago, he goes, George, machines don't get emotional. They're just VWAPing along, okay? And so rather than having the headline grabbing markets down 10 or 15% in a day or 2 days, and people say, oh, that's the low. for weeks upon weeks upon months, we had no capitulatory low, no cathartic event, but yet you still wind up with a huge down. So it's it's death by a thousand cuts. It just grinds people down. So when you so coming back to the question, I know I'm on a rant here, but
Mm-hmm.
you gave me an opening. Plus, we give you a chance to catch your breath, and maybe I'm triggering you with some of this nonsense. Um, the misuse of surveys, the misuse of options data, the misuse of sentiment data. It just, and then there was another one. The other day, I shouted someone down. Not that I ever do that. Someone wanted to talk about volatility. That's another one. Okay, they're going on about the move index and the ratio of the VIX to the move and the move to the VIX, and I get a headache trying to figure this all out. And I say, oh yeah, that's what that means. And it's like you get the smartest guys out there who do VIX. There's that guy Chen. We got to get him back in here. And it's like he's even crying. It's like the guys who specialize in this stuff can't make money out of it. And so it's like a lot of noise. I just kind of block it out and ignore it. I just want to come back and focus on price. Forget about trying to measure, is Jeff in a good mood or a bad mood? Is Jeff bullish or bearish? Is Jeff's next door neighbor buying options, calls or puts? Just focus on what the damn stock is doing. So I don't know if any part of that triggers you, Jeff. Thoughts, comments, reactions?
No, it does. I mean, price is important. That's the technician in you coming out, George, and I appreciate that. The surveys were always an issue with me. That's why we used to love put call, and we liked the one, or you always loved the one that was in Barron's. That was the weekly put call. It was sort of a little 5-day, smoothing, but that has had trouble being calculated properly, so that's not existent. Um, the thing with sentiment indicators, survey or otherwise, they're not always giving you an indication. It's more at the turn, and that they're there to notice that. It's been harder and harder to see with some of the, just information overload out there in the world, and the fact that the options, business and volume and markets have changed. The sentiment indicator that I like, the investors intelligence one, is the same way. It's not taking a survey; it's somebody making a judgment on what newsletter editors and writers and analysts are writing. Like, my headline that or what I'm writing about says bear in it, even though I'm only bearish for the next 3 months, they're going to put me in the bear camp. Larry McMillan, do you know Larry?
I don't. Who is Larry, please?
He's the option strategist. He's old friend, a sort of an elder of mine, but he's got some great sentiment indicators with some weighted 21-day moving averages built into there, and he does a really nice job of identifying those turns. Again, not perfect, not 100%, but
For listeners again, what's Larry's name? So people want to follow him, Jeff. Larry, what's his name?
he's McMillan, and he's
Larry.
the
Okay,
option
Larry.
strategist.
Option
Good friend
strategy.
of mine.
Okay.
I have a note to call him. We got to meet for dinner one of these days.
No, we'll do
Again,
that because Jeff, you talk about sentiment. I just kind of took the view. And I'm not saying to challenge you, but I just said to myself, you know what? And again, you got to think about when is the market not doing what it's supposed to do? And you look at things like positioning. You look at the fact that rates were like at the lowest level in recorded history. Profit margins are 1,000,000% extended above trends, et cetera, et cetera, et cetera. And you have all these talking heads on FinTwit and mainstream media just talking about sentiment. And I'm like, dude, you're just not getting the picture. So, Jeff, and again, this
when
is probably more a reflection of my shortcomings than anything else. His sentiment, I mean, this year, let's be real. The market's had a few rallies here, and I think Thornton came in the room. I love Tommy. He's the only guy I know who's gotten these counter trend rallies right. But the reality is, the bigger picture for someone who's not trying to trade these things, it's like the nose of the plane has been pointed down. And if you just said, you know what, I'm going to be invested for the next year, forget about calling these 1-2 week, episodic dead cat bounces. I just want to get the big picture right. Because, okay, Jeff, I'll take your advice to get long for the next week or two, but then a week or two, I got to take your call again because you tell me to get back out. It's like,
right,
no, I just want to know the big picture, right? And so, viewed through that lens, not trying to catch the wiggles and jiggles. I mean, like, how is sentiment getting away from the weekly stuff? How is measuring sentiment helped at all in the bigger scheme of things? It's been misleading. The direction's down. What would you say to that?
I would say that if everyone's talking about sentiment, it can't work because it's a contrary indicator. So if everyone's talking about it, it's not working. And I think the trend is down, and it hasn't shown a turn for anyone that's experienced looking at sentiment. We've been looking for put call to do something, and it hasn't for a long time before this bear cycle. So I think sentiment indicators have changed and are not as indicative as they used to be, and we do not rely on them as much as as we could have as we were able to in the older days. And the only thing that's giving me um, any sentiment or psychological indication is this investors intelligence bullish and bearish advisors percent. Um, it's it's something that's shown some consistency, and there's a knowledgeable, experienced person formulating it. Um, and I agree that the long term right now is there's
Jeff,
no
on that point, Jeff, and Thornton's going to come here in a minute, I'm sure. Could you explain for everyone in the room, like, why you like investors' intelligence better than AAII and how they're different? Because I agree with you completely. Could you just weigh on that a little bit? Elaborate a little bit?
It's not really a survey of asking people what they're doing. It's sort of a combination of the what their people are buying or selling. It is taking what you know services that people spend money on, mine included, and taking what their market calls are, and it's got a history, um, and it's makes sense as to how it's built. So it's not just one of those AI
All right, and
survey.
has that one been the II sentiment survey? Has that been helpful or had more utility in 2022?
It has, but it's also bouncing around, and you got to go back and compare it to some of the, not to like '08, '09, as far back as you can go, and you can see that this that comparison's been more helpful to me because you can see how it bounced around, was up and down, and you're not going to pick the bottom on anything, and you're not going to pick the bottom on a sentiment turn. You got to wait till you see the other side a little bit. You got to have a little bit of hindsight. You got to be able to look in the rearview mirror a little bit to see if that was the bottom, and we haven't seen that yet. It's come back up. I mean, the part that I look at is the difference between bulls and bears. So when there's a lot more bears than bulls, you're getting to that period where going long is the risk is reduced. The odds are better, and then you look for that turn going from many more bears than bulls to not so much to more bulls than bears, and that's when you see a trigger. But admittedly it's been more helpful, but not clearly indicative just yet.
Yeah, no, I want to bring Tommy Thornton in 1 second, but last thing before Tommy speaks up, in similar fashion, listening to you speak, I take Sentiment Trader Jason go for
stuff.
service. He's good stuff, and I have an email out to Jason. I hope he'll come in here and talk. He takes kind of a low profile, but he has objective data. I'm sure you're familiar with his methodology: dumb money, smart money. Okay, and just recently, like last week, that thing got to an extreme where the divergence was, like, if history's any guide, which it may not be, and I would argue it's not, but that's another discussion. That's me moving the goalpost. Okay, but
that's where we disagree.
I know. But but the point is that one was saying last week, showing the last few times it was extreme as this, the market was a buy, and it trots out the subsequent returns and blah blah blah. Okay, but that thing was useless this entire year. I mean, it didn't say it wasn't an extreme buy, but wasn't saying sell either. And so, if you say, well, it's kind of okay, it's a little bit negative, meanwhile you had a 30% off sale if you didn't sell anything. So anyway, that's awesome. Listen, I want to make it more interesting here. This guy knows much more about this stuff than I do, and he has a license to speak about calling turns because he's done it 3 times now this year. And I'm sure he's got a good question for you. So, Tommy, good to see you. You got a question for Jeff, Tommy?
Hey, Jeff. I've been a big fan of your work and your father's work for many years, and I agree with. I just jumped on, so I heard a few of your comments, but I do agree that sentiment is it's difficult to use as a strictly timing tool. I also am not a giant fan of the AAII sentiment poll because it gives respondents a reason to be a little, well, they don't make a strong commitment. They can say, are you bullish or bearish, or are you neutral? And a lot of people would rather just say I'm neutral instead of making a real definitive call. And back when I worked at my hedge fund, if I walked up to my head PM and said, "Look, he goes, what do you want to do?" Well, I'm neutral. That was just a good way for me to get some scorn thrown at me. I also like the Investors Intelligence poll a lot, and I find that to be of a lot of very good info uh, throughout that. I mean, because it is really what a lot of very smart people are saying about the markets, and in many respects, it definitely leans for the most time for bulls. It's easier for people to have a more bullish view, but it's important also when you have periods like this we've had for the last 6 months to look at it and to understand the environment that we're in when those uh, indicators get to extremes or break through certain levels. I also am a big fan of Jake Bernstein's Daily Sentiment Index. Um, I think it's valuable. But one thing to also remember, and I think you'll agree, is sentiment is a condition. It's not necessarily a trigger, and a lot of people reverse that, and that's where things go wrong. And you can also look, especially with the Investors Intelligence or DSI, you can chart it and you can see the ranges of what happens in bear markets. And much like an RSI, when it's under 50, you're in a bearish environment because the majority of people are bearish. And that's generally what I've been seeing and talking to George about, and everybody on George's Spaces, that's the environment we're in. And it's gotten to a point where things are really, really deep for a lot of different stocks, and we just are now starting to see uh,
Mm-hmm.
earnings start to get crushed with margins, and the consumer is now in front and center um, with a major slowdown. So I think that we still have problems going forward because there's a lot of stocks such as, let's say, Apple, Microsoft, Tesla, um, others that have not really corrected significantly, or let's just say enough to signal anything worth buying. I flip back and forth between long and short in these environments. You got to be nimble. You got to keep your sizing down,
Or
and
patient.
be patient and admit when you're wrong to move on certain things. And that, I think, is the bear market tactical trading modus operandi for 2022. And I think, just since we have all these big mega cap names coming out this week, and we have Fed, we could get some really wild swings, and we could get a bounce. If the Fed has any sort of dovish tilt, well, we're gonna, I said yesterday to someone, if they say, well, it looks like 50 to 25 basis points, it could be seen as, wow, they're even thinking 25 basis points, and that could be seen as dovish for them. I
You
still
mean 25 this week or in
No.
September?
I think 75 is definitely going to happen. I thought if we were over 4,000 ahead of the meeting, then 100 would come back on, but 75 has been the base case.
Mm-hmm.
And I
Agreed.
think they have enough cover to do it at that point. So anyway, I just want to say your work's great. I think the sell in May started in January.
Yeah.
Hey, Tommy, can I ask you a question? Because you may have not heard the earlier part of the conversation, but maybe just before you stepped in. So, Jeff, you and I are in large agreement on this. I guess the specific question I want to ask you about sentiment. Have we all grow, markets change. It's that famous, Loeb quote, just when you figure you got the
They
keys,
changed the locks.
they change the locks. Exactly. Okay. So Tommy, have you rolled with possibly changing the way you use sentiment or what indicators you use or don't use? Because Jeff was talking about the graveyard of sentiment, the graveyard for indicators. So, like, what changes have you made in terms of how you use sentiment, or what sentiment indicators you look at? Tommy?
That's a good question. I think it's just from experience. I've used when sentiment gets to low levels, I recognize that it can stay at these types of levels for a while, and I try to use other timing indicators, such as I use a lot of DeMark indicators, and that has been very good. I use waves as well. I use the DeMark wave counts, and those have been very, very good. And that actually tells you what, not necessarily like people get lost on Elliott wave stuff with Fibonacci levels and that whole thing. But I think it's important to understand the personalities of the waves of what's happening. And, the first wave down is where people think it's just to buy the dip. And that's why we had stronger rallies early in the beginning of this whole episode. And then the rallies have gotten weaker because you've lost a lot of the by the dip people. So my thought, another thing that I also look at, like, let's just say percentage of stocks above the 20, 50, 200-day moving average. Those have also been in bear market patterns as well. And you'll get, short-term spikes higher. Like, for example, I look at the percentage of stocks above the 50-day moving average on the S&P, and that bounced up back to levels that we saw at previous peaks, or short-term peaks this year. So I kind of watch where other things, for at other times and places of levels, basically on the internals. Um, what else am I focused on right now?
Yeah, Tommy, I know
Yeah.
you can't be with us too long, and I don't want you to give away stuff. By the way, I read Jeff's stuff, I read Tommy's stuff. This is all great stuff, unbelievable value proposition. But Tommy, just because top of mind, too many secrets away. A couple of high profile names. We saw Tesla come out with those absurd earnings statement last week. What was really absurd was not the earnings, but the reaction to it. To me, the stock looks like a great short right here. And then also Apple, we're waiting, and there's been enough warnings. I know you've been writing about that, and the consumer stocks. So just real quickly, if you could touch on Tesla, the consumer stocks, and Apple, just quick hits.
Well, I covered half my Tesla short. I only maximize my position size at 5%, so I covered half my Tesla before the earnings at a little profit, and then I added back after the reaction, like a day after the reaction, and higher, and so I'm back in the money again. Yay! But I will say, as far as some sentiment, one of the things that I just anecdotal, people are really, really still very, very bullish on Tesla. And I was in Los Angeles and I rented a Tesla Model 3. And I'm a car guy. I put out my thoughts on the car, and I got a bazillion people that commented, and the Tesla loyalists are still very, very loyal to Tesla, and they once that breaks, then you're going to see this really fall apart. I think just a couple things. I think Elon Musk is more at risk of losing his job. Need more time now than ever. That's, I think, a real risk for him, and that is a problem. Mike Green said something in a Spaces recently that it really doesn't matter with Tesla because there's no sellers. The big holders are Elon, the big mutual funds that are passive. They're not going to sell. And I wanted to comment, but I couldn't at the time. But Larry Ellison just resigned from the board, and he's got 15 million shares of stock that if Larry decides to unload, Remember, Elon, moved the stock down 20% when he sold 1 million shares. So 15 million shares, I think, would be some significant supply hitting the stock. Of course, the stock went up after earnings. They barely met earnings, um, and they met lowered guidance, which was manipulated by the IR there. So it's essentially, um, we'll wait for another shoe to drop with Tesla. But I think you're right. I think it's a very appealing short right here, and you can use basically, I use very wide stops on this, and I would use perhaps the high as a stop if you want to have a little bit in there. It's the hardest stock I've ever traded. I've made money shorting it by just trading it, and I've lost a few times on it. I'm not one of those that just shorts it and puts it away, because you just can't with this thing. So I think that's a problem. As far as consumer stocks, I think Amazon is at risk. I shorted that last week, just a little. I think you have this Walmart news is very, very significant for so many different reasons. I'm short Dollar General. I think that's at risk as well. And I also can say I'm short. I shorted McDonald's yesterday, Whirlpool, and what else did I do? And 3M. So I'm really, I do lose money sometimes. So I'm wrong on those right now, but overall, I'm net short again, and I think that we're at risk if these Apples and Microsofts, which I'm short both of those, if those turn out to do a Walmart dive, I don't think people are prepared for that. They're crowded. It's very, very crowded stocks.
I appreciate that, Tommy. That's great. Hey, Jeff.
Yes, sir.
Could you talk a little? I don't know if you look at it much, but how do you think about flows? I'm big on flows, and one of the mysteries to me has been that retail's actually put money into the market this year, or whatever. It's a de minimis compared to I can't even remember. Took a little in, took a little out. Doesn't really matter. The point is, they haven't sold anything really, relative to the trillion plus they put in last year. And kind of what strikes me is, I always talk about there'll be a period of time where people just don't even open up their statements. They're they either aren't aware of how much they're losing because they see the soundbite averages, or they don't want to look. But as the old line goes, denial is not the name of a river in Egypt. And at a certain point, they look, and shock and awe and horrors. And we're coming up deeper into the third quarter here in September, October. Seasonally is not a good place. We got earnings falling apart, et cetera, et cetera, et cetera. Do you ever look at flows, Jeff, specifically, and trying to get on the right side of flows? And do you think that flows potentially present a really big risk to the market right now?
I don't track that, as a market analysis tool. It's something we track on the Almanac on a seasonal basis. I think that the people haven't opened these statements so much. I don't think we've seen that shoe drop yet, and that's probably why the flows have not been so negative. They haven't increased, but I suspect that there will be some outflows as we get into the seasonal period, the negative seasonal period. So there's a section in the back of the book about cash inflows into the market on a seasonal basis. People tend to pay their bills and make transactions at the beginnings and ends of months when things are due. And this was one of the things that Yale discovered when I was sitting next to him, or at least working with him, back in the 90s. Was there used to be the last day of the month and the first for the new month were was the monthly bulge, the monthly 5-day bulge, where most of the market's gains were made. And the rest of the month you could have just gone fishing. And then we noticed, and this was one of the calculations that I tracked by hand with my little ruler and the graph paper and adding machine and the red pen. We noticed this mid-month spike that began to appear. And, we look for correlation. Admittedly, not everything you see seasonally is or cyclically is easy to correlate, but this correlated quite well with the payroll deductions, the biweekly or or bi-monthly or twice a week payrolls going directly into the market in everyone's, whether IRA, 401ks or whatever. And that was driven by flows because the fund managers, unlike you and I, George, can't hold cash. Um, and I think Tommy missed that earlier on that we had that little cash discussion. So cash flows are important, and that's something that while we look for sentiment indicators that are working, that's something to definitely be considered. We look at internals. We've seen psychology continue to, bears continue to ride the market lower. You can see it in the advanced declines, the new highs and new lows. We've had, multiple, was it like 30 some odd weeks of more new lows and highs across all of the indexes. So, I mean, the flows, I don't think have shown up, just like I don't think that the inflation has really hit fully the consumer and the economy. And we're starting to see that happen now. But it hasn't really rolled that into the economy. And I think we're going to see some flows dry up as we get into August and September and that seasonal period that's notoriously
terrific.
negative.
That's terrific. Thanks, Jeff. I'd like to just reset the room here. We've got Jeff Hirsch of Stock Traders Almanac. Real tour de force here. It's fascinating. Just so many things going on in the market, and Jeff is doing a terrific job covering the waterfront here. Tom Thornton, a longtime friend of the room as well. And I'd like to bring in Neely, who is forgotten more about consumer stocks than any of us will know. And I'm sure Neely, inquiring minds would like to know, look at the Walmart news and other assorted disasters. I'm sure everyone was breathlessly. I actually, what was the most interesting news to me yesterday before Walmart was these barbecue companies, like this Weber Grill thing. All right, like this thing has been a POS. That's not the ticker symbol. If people want to look at POS, look it up in the Urban Dictionary. This has been a sink or not a floater from the beginning. And it's like, is no one on the face of the planet who might buy a grill who hasn't bought a grill? And this thing, they brought it public. Their timing could not have been better. They loaded the thing up with a ton of debt right at the top of the work from home, thing. And it's been a one-way trade down. And it blew up again, I think, yesterday. But this is just emblematic of what's going on. And so, of course, yesterday after the close, we had the Walmart news. So, Neely, update us a little bit what you see going on in the consumer sector. And I just, I'm sorry to be as, and for those of you that weren't old enough to know, Spiro Agnew was the vice president under Richard Nixon. God, was a flaming asshole. But he went after somebody. I can't remember what it was. He accused someone of being a nattering nabob of negativism. Well, I am a nattering nabob of negativism when it comes to consumer stocks. So, Neely, am I being too unfair? The floor is yours, Neely.
I heard that CEO got grilled. He got raked over the coals. He was under fire. I don't know. You can take the girl out of the south side. You can't take south side out of the girl. I would have had a heyday with those titles. But nonetheless, and it's stories like that you're like, how is this even a standalone company? I mean, like this is something that like a Jarden should own, you know what I mean? Or something under a conglomerate. But, bravo to the bankers. They figured it out and they timed it well. They don't always get to do those things. So, it is what it is. At a high level, we've been very concerned about inflation and how it affects different demographics differently for quite some time. We actually, I think the George, we were on the sell side for 20 years, and 6 years ago we decided to pivot and start our own advisory business. We now advise CEOs and boards on the interior side of non-disclosure agreements and help them navigate exactly this type of news. So, obviously we can't speak to specific client conversations, but by nature of our job, we've been talking about this with our corporate clients going back to last summer, literally a year ago, and helping them navigate and make some decisions internally. I think from here on out, the things that we're kind of looking at, and it might be a little bit too myopic maybe here in the near term, but I feel like a little bit of nuance is required, is we're going to have these kind of mixed signals. You're going to have the the mini state stimmies, right? As it were, we have 49 out of 50 states in surplus. They're going to redeploy it because it's midterm season elections, and they're going to try to redeploy these surpluses instead of actually reinvesting in the municipalities to their people for votes. That's going to be this kind of short-term boon, basically, to consumer spending in micro targets. But then you have other issues around the corner, like the potential for, although this came under question in the last 24 hours, but the potential for student loan forbearance, finally coming to the end after being kicked down the curb for 6 times, going on 7 now, potentially. So we're watching for those nuances here on the consumer's capacity to spend. But at a very high level, when a Walmart misses, when a Walmart misses, I cannot stress this enough, having covered the consumer sector for 20 years. When Walmart misses, it's a big problem. They're the largest single employer of people in the private sector in the United States of America. And, basically they told you they're going to be down 10 to 12% on their earnings because people had to choose between clothes or food. Like, that is a problem, people. That is a very significant problem. So while I hear you on the negativity, perhaps I'm just being negative Neely. So hopefully that helps you, George.
Negative Neely. I like that. Ooh, negative Neely. Double N. Cool. So, Neely, let me just play devil's advocate. When you look at the composition of what's going on inside Walmart, and again, we'll keep it at a higher level, so you don't get into stock-specific ideas. But when you talk about it, it's really horrible when you think about it. Such a large portion of the population having to choose between what they need versus what they want. I mean, I just think about not just grills, but apparel. Going out to eat. I mean, I know I put a graph up a couple weeks ago. It showed, I think, sequentially month to month, like spending on travel and restaurants is actually down. Like, that's not supposed to happen. So the whole discretionary part of consumer spending, travel, eating out, apparel, all those types of services, like, to my way of thinking, in the 40 years I've been doing this, I've never seen it this bad. What would you say?
Well, I mean, have we? I miss precedented times, right? I mean, that's the joke. I think we're still very much in these unprecedented times. It wasn't normal to hand over $2.1 trillion of direct stimulus payments and programs. It wasn't normal to fire 24 million people and have immediately, by the way, during the summer of 2020. Most people forget this. This is actually one of the most enlightening conversations to guide boards through right now. Is, think about this. You had 24 million people that were instantly fired April of 2020. And more than 75% of them, I mean, we've done the math, okay? We've published this, we've done the math. More than 75% of them on that day of being fired were annualizing 30 to 50% more in their annual income because of the federal pandemic unemployment compensation of $600 a week, in addition to the state's benefits, in addition to the direct stimulus payments. I mean, we've had a massive fracturing of trust in the workforce. And, allowing people to wear jeans on Fridays is not going to cut it on the other side of this. So there's a lot that we think about beyond just the consumer's capacity to spend. We also think about the consumer's willingness to spend. And one conversation that just does not get talked about enough was the fracturing of trust. Fracturing of trust in public health, fracturing of trust with employment, fracturing of trust, with efficacies. I mean, like, people are just, and people don't spend when they're angry or afraid. You know what I mean? So I'm just waiting for that tipping point just a little bit on what that might be. And going back to the point, though, of the spending hangover, I mean, I definitely get some pushback. People are like, oh, travel spending's up significantly, and miles. And, we all see the pictures of the luggage issues. And Like all true, all true, all true. Also for backward looking, not forward looking. You're gonna have one heck of a visa bill hit on the other side of summer vacations, right at a time when back to school goes into effect, right at a
100%.
time, right? And right at a time when you have overage of inventory where people are going to be able to be choosy. And to your point, clothing carries that higher margin goods, which is
Okay.
exactly what Walmart has the issue with.
So I'm gonna make a confession here. I really shouldn't do this, but it's such a funny story. People gonna want to hear this. I'm never gonna live this down. So I live in Westchester County, just outside New York City, and I was supposed to go to see the Yankees play the Orioles in Baltimore on Saturday night, and I was all pumped. But then, as the game day drew close, the forecast for 6 p.m. when I have to walk over to the stadium was 95 degrees. It's like, Neil, if I said to you, hey, let's go to a baseball game, it's 95 degrees out. Like, I don't think most people would go for that. So I said, you know what? I'm not going to do that. So the trip was planned to go to Baltimore, see the game. Decided on the way down, maybe we go to the beach, whatever. And so we went down to Cape May, New Jersey, which, by the way, if none of you have been there, it's just an awesome, awesome place. It is just gorgeous, and it's a really chill vibe. So what happened was, Carpathia, I know you're ex-Philly guy. So I go down to Cape May. I managed, by luck, I was up at 5 a.m. on Friday, managed to grab a hotel room at, like, I'm not going to even say what the price was. I didn't really care at that point. It just, if I put this in public, people say, like, you paid how much for a room in Cape May, New Jersey? But I got a better one for you. So I go down to Cape May, decide to change my plans, bag Boulder. Now I need a hotel room for Saturday night. Imagine this, Neely. I'm in Cape May, New Jersey. I don't have a room. I need a room for that night. I go on Kayak, TripAdvisor, Airbnb, the whole deal. The entire Jersey coast. There's like nothing because the whole state of New Jersey's moved to the beach. Well, I don't know. Maybe I'll have to like delete this part of the recording. And if you know anybody who, if you've ever been to Wildwood, New Jersey, or if you know anybody who's been to Wildwood, New Jersey, I apologize. But this was like, for those of you who remember Dante's Inferno, I think he forgot the 11th circle of hell. It's called Wildwood, New Jersey. And I knew this going in, but desperate people do desperate things. So I grabbed a room. Nearly, I swear to God, this is like one of these no-tell motel places, which back in the day, would charge by the hour. Maybe if you stayed overnight, it'd be $59. All right, adjusted for inflation, maybe $119 on a good day. I mean, nearly. We're talking multiples of that. And as long as the bed bugs were like not too large, I was going to stay there because I needed a place to stay because I got to go back to Cape May the next day. Nearly, I could not believe, and actually, aside from trying to be funny, which maybe this is not, there's actually a serious question coming here. I've seen this term used on the FinTwit. Maybe you originated. I don't know. It's not used that widely, but I thought it was a pretty cool term called greedflation, not greenflation, greedflation. In companies charging, gouging because they can. And we've had Jackson in here talking a lot about at Starwood, they jack rates like crazy, but in Jackson, you got to come back up here. I see you're down there. You're hiding in the third row. About how the top line didn't flow through to the bottom line because costs went through the roof. But when you start thinking about, and Neil, I'm sure you have thoughts about this at a high level, when you look at like concentration in industries and Gini coefficients and this and that, and companies' ability to jack prices. I mean, if they were really extracting monopoly profits, I guess you expect to see it in higher profits. But in a lot of cases, you're not. So I think what Jackson's been talking a lot about, cost pressures coming through, just eats away the extra profits you get from raising prices. But the general question I really have here, Neely, for you is this concept of greedflation, of gouging. How how widespread is it? In many cases, are companies actually able to show higher profits, or the cost pressure is just so enormous it hasn't been the case? And then beyond that, do we expect prices to come down? And maybe not in every industry. I mean, I totally get it. Airline fares will go down, hotel prices will go down, but I don't know that Kellogg's is going to reduce the price of the cornflakes. So maybe just talk, and this is really very relevant because I get people talk about inflation and say, well, it peaked in June and blah blah blah. Okay, it's fine, but if you drew the short straw and you're the lower end of the socioeconomic strata, does it really matter that the box of the cornflakes is now annualized at $5? Okay, great. So month on month sequentially, it's not going up, but it's still up 1,000,000% from where it was a year ago. So I don't know, Lily, Neil, there's a lot to unpack there. So I don't know what part you want to address, but there's a lot of moving parts here. In I don't know the answer, but I certainly know the question. I don't think the market's figured this whole thing out yet. So, Neely, deal with whatever part of that you wish.
Okay, that was a great story. Number one, At that point, I think I would have just been like, fire up the private helicopter and get me home. Anyway, but I would just say the thing I'm contemplating. I don't have answers, but the thing that I wonder, on like a Friday afternoon as I ponder the wonders of the economy, which is true, is it's not about an absolute number. It's how it feels to people for how long that will shape consumption behavior. And we just don't really have too much of an example of that. I mean, I do have a database of CPI data that can take you back to 1913, and we can run all sorts of numbers if you want. But, we still haven't seen shelter come through on that CPI print. If shelter does what it's done historically and transfers through to a year later, it's delayed by, about a year or so. That could be in and of itself 660 or so basis points of CPI, just at a 20% sort of growth rate in housing prices, if they're honest about it, right? So I'm more concerned about not whether or not we're going from 9.1 to 9, right? Or 9.1 to 8. Are we going to be at 6 for 6 years? Like, that's the sort of thing I think about when we do math exercises.
Nearly 100%. Keep
right?
going. You nailed it. Keep going, Neil. You got it.
Yeah, I mean, so that's actually what I'm more thinking about. And where is small business in all of this too? I mean, we've got, I think the statistic that flows out there, I haven't personally verified this, but it's like there's 12 million businesses owned, basically small businesses owned by baby boomers, right? And we can see, because this is verifiable, I can throw this in the nest in a bit, but you can see that retirements are spiking again. They're kind of resuming what they were doing pre-pandemic. And, their kids probably don't want their businesses. And so, that could be like an awesome opportunity if you want to make your own little Berkshire Hathaway, and buy a bunch of local businesses and try to help them figure this all out. But, it's, I'm really concerned about these business exits too, because we're done. You know this, right?
Neil, let me ask you a question related to that. So I was reading something yesterday. It was on Twitter where it was talking about the quit. I'm sure you know the answer to this. So good to have you in these rooms. You got to keep coming back. This is awesome. So annoying question, but you're the type of person that knows the answer to this. So it's talking about the quit rate for employees. It was like 25% or some number like that. And then it started going to all the reasons why. I'm sure you saw the article. It's like, 40% said they weren't getting paid enough money. 30% said something else, blah, 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 blah. But from where you sit, why has the quit rate been so high? Like, what would you say to that?
It's boomers. I mean, it's the two things we've been dissecting. Largely, it's boomers. I mean, yeah, there's some other turnover and things like that too. I'm not trying to dismiss that, but like the sheer number of boomers, we have like 70 million people age 62 and older. It was like 44 million people 20 years ago. Okay, I mean, like, it's just the numbers of boomers. So yes, they're working longer rate, right? And they're also exiting numbers, right? Like, both can be true, rate and numbers. And it's verified, of course, in the Treasury data that you can see Social Security benefit payouts. And again, I'll post this stuff in the nest when I get a second. But it's the boomers that are exiting. Now, here's what's really just whack. Everyone will point to labor force participation, right, as being like, oh, we peaked in 2000, and we've got to get people working again. If you look at labor force participation by age demographic, the primary contributor to why we're under participating in labor, to state it back that way exactly, is if in the 16 to 19-year-old category. Like, we fundamentally have changed the value of what it is to flip a burger at the age of 16 today versus back in 2000. And that actually kind of bums me out, to be honest.
Wait, stop. That's a very important point. You're saying the biggest decline, the biggest decline, contribution to the decline in participation rate is in the 16 to 19 category. Is that what you said?
Yeah, I've got a tweet I'll put in the list.
So people don't want to flip burgers anymore. So you got that, and then you have what? A lot of the boomers just saying, "I got enough of a nest egg. I'm done. I don't need this headache anymore."
Yes, and here's the good news. Negative Neely will give you one awesome good news. We've been saying, and people have been laughing at us, okay, but we've been saying all year, 2022 is going to be the year of intentional baby making. We're going to see birth rates positive again. Most people don't realize, if you look at the provisional data of the CDC, you can look at 2021's birth rates. We exited December 2021 with birth rates up 6% that month. We have not 6% in 20 years. People bought homes, they upgraded their jobs, they bought cars, they got married, they are having babies. And you know what I think's happening? Is grandma's going, you know what? Now I know what I want to do with my time. And I'm going to help my daughter out. I'm going to help my son out. I'm actually, because during the pandemic, we got in our COVID bubbles, right? We changed how we interacted with our family and our small little tribes. And trust was rebuilt. I told you about the fracturing of trust. Trust was rebuilt in these micro tribes. And these micro tribes include grandparents. And I think that is beautiful. So I'm really super pumped about the long haul of where we are from a labor force participation, labor force, quality. I'm not all doom and gloom. I think it's going to be a little doomy before we get there and a little gloomy, but I'm really positive about this wave of babies coming to the United States of America and what that's going to mean.
Wow. Hey, Jeff, you've had your hand up for a while. Jeff, over to you.
Sorry, guys. No, some great stuff there, Neely, and also what we had from Tommy before that. I have to jump it a little bit, and I really could be here for hours with this conversation, but I've got to get back to proofing and putting the 2023 Stock Traders Almanac to bed so we can get that off the press for everybody in late September, October. But, I don't know if you wanted any final thoughts or if I should just say goodbye and we'll pick up on other stuff in the future. But,
So Jeff, it's been terrific having you. I hope you'll come back. And I hope you'll become an honorary elf, as we discussed. I guess just for those who weren't in the room for the last hour and a half, just and aren't going to trade this thing, week to week, and they're going to say, "Oh, I heard the smart guy Jeff Hirsch on, Mr. Stock Trader Almanac, blah blah blah." What are like the one or two key takeaways you give them? Say, between now and the end of the year, or what are your highest held convictions about anything? I mean, just to. Yeah, they say, "Oh, the guy's satisfied." What did he say? Like, what do you want him to say? What should they take away from this conversation, Jeff?
I mean, cash is our main position right now. It's okay to be in cash. It gives you time to think. We are bears right now. We're not as long-term bears as you are, George. We're looking for the market to continue tracking the 4-year cycle to a midterm bottom and also the seasonal cycle, which will put us at a low sometime in the August to October timeframe. Could be a very typical October bottom. And then we see a rally upwards, another cyclical bull going forward. But right now, it's sit tight, be patient. Couple of sectors we like. One for the long haul is biotech. I own XBI myself. A couple of seasonal sector trades on the short side is transports and industrials, IYT, XLI. You can go to stocktradersalmanac.com and look at the particular levels. We're either shorting at resistance above where we are or breaking through support. And, other than the cash as a position and waiting for the to pounce on that midterm bottom, those are the three sectors we're looking at right now. On the stock side, as I said early on, we've been stopped at most everything. The stocks that we look at, we use a fundamental screen with a seasonal overlay and technical analysis, and we're going to wait till we get that fat pitch in the fall, the seasonal and 4-year cycle pitch to go through and do some fundamental screens and technical stock picking. And up until then, we're just being patient, enjoying the summer.
Jeff, that's fantastic. I hope you come back. It's been awesome.
Most definitely will.
Yeah, Jeff is a must follow at Almanac Trader. Great service. Jeff, we'll grab a beer one of these days. We still got to catch up with Guyed. Have a good one, Jeff. Great talking. We're going to keep talking here for a little bit, so that's awesome.
Thanks again, George. Be well, everybody.
My pleasure. Hey, Newman, could you come up, Newman, if you're there? I got a question for you. I don't want to ask. If you can shake free for a second, Mark, that'd be awesome. So Neely, so you're talking about this baby thing, like, so whereas it's interesting because that flies in the face. I'm actually very surprised, happily, flies in the face of stuff I've heard recently where people are talking about declining fertility rates and whatever, and particularly in Europe. And so that's really good news, because when you look at growth rates, population growth is obviously a key factor. But you mentioned births up 6% in December year on year. Like, that's a huge number, isn't it?
It is. I'm trying to find where I tweeted this, or maybe I didn't tweet it and I thought I tweeted it, but now I will tweet it. So just give me a few seconds and I'll post
it.
But it's and here's the deal. I am unabashedly in service to the U.S. consumer. We get calls occasionally to do keynote speaking for global stages, and I'm like, if you want me to talk about the consumer, I'm in, but like, do not ask me to give that same level of care, to any other economy. There's only so much the girl can do. So I have no clue, but I do know that we are unique. With having, if you think about the shape of our population curve being like a bimodal distribution here in the United States, right? Like, we're unique that way. Japan doesn't have that. Europe doesn't have that. Like we have this kind of two-humped camel, right, of population. And going back to, you can Google this. You can Google articles where people are like, millennials will never want to own anything and they'll never like move out and da-da-da. They've been buying homes since the end of 2016. They have been, I've got this great chart that I have that we put in some of our decks for our clients around. You can just look at Signet's jewelry sales. They published their bridal sets. Like, it was up more than 40% in 2021. That's, by the way, engagement jewelry, which means weddings are 2022, which means babies are still to come. So, there's all sorts of fingerprints of life stage, not age, dictates birth rates. And we're seeing that finally kick in. It's definitely been later, right, than generations before. But I think it's really cool. And I'm here for it.
That's awesome. So, Newman, you got to get up here. So, for those of you, I'm sorry. So, there's a stock. I'm going the Wayback Machine here. So, you think U.S. investors are the only ones who follow narratives? It's true everywhere. And in Japan, there's a company called Okamoto Industries, ticker symbol 5122. It is one of the world's largest producers of condoms. The stock closed at 4,000 yen. It's trading around book. It looks like it's around 12 times earnings. So I don't know. I was wondering if Newman could provide some research. But anyway, sorry. I just couldn't resist that one. All right. So, Jordan, you've been patiently waiting. Jordan, you have a question? Welcome, Jordan.
Thank you for this. So, not a question. I just wanted to jump on Neely's point. So just to give you a quick little anecdote as far as some background goes. So I work in audit, and my wife quit her job this year to start a greenhouse. So she's left the workforce. My brother, who's also a millennial, had triplets this year. His wife was an accountant. She quit her job. And my mother, who is a teacher and in her final years of teaching, decided to call it quits early and do nothing but take care of the 3 new babies that are here. Just throwing that out there, I think the labor force partition I can't speak participation rate is somewhat skewed by what we believe are normal trends that are happening. I think those trends are going counter. I think we're starting to see the single family income pop back up. And I think people are up. They've been home for 2 years with COVID. I think people are starting to believe that they like being home. And I think that is changing the narrative. And my opinion, not a stock guy. I'm just telling you what I see on the ground. That's all. Thanks.
Appreciate that a lot, Jordan. That's great. By the way, Neely, one question I want to ask before we go to Newman, and we got Jeff Garbaz in the house too. That's great. Before we go to Newman and then Jeff, Neely, if the labor participation rate stays down, and you have the sort of misguided policy coming out of Washington where they look at the number of people employed compared to what it was pre-pandemic, and they say, oh, there's still all these people that we got to get back to work. Then you juxtapose that with the record number of job openings. It kind of makes me think that, and you were talking about here. I'm sorry, I'm going all over the place. I'm scatterbrained. But you were talking before about inflation, the rent thing flowing through with, being 6 and staying 6 for years to come. Well, labor is one of the key determinants of inflation, and more importantly, corporate profitability. You look at productivity, you look at unit labor costs. And if policymakers continue want to run the economy or in the side of hot, leaving inflation aside for a second, just rolling forward, if you say to yourself there's not going to be as much surplus labor or slack in the labor force as there was historically, because the participation rate not only has gone down, but it's going to stay down. And Miss Shedlock, for those who don't read his stuff, he had a great blog. It was the other week. I think I put it in my feed. Miss Shedlock was a great piece. He was talking about a long but shallow recession. And the basic idea was companies are not going to really shed labor like they normally do or have in past cycles because they've had such a hard time in attracting and retaining labor that they're going to hoard labor. And shedding labor is one of the levers that companies historically use to, increase profit margins. And so that in order to kill inflation, if the idea is we need to free up resources, be it energy, be it labor, we can't really control oil, but we can control labor, that we need a recession. We need people to lose their jobs to create enough slack to bring prices down. And if companies relative to past cycles are likely to shed less labor for the reasons I just alluded to, it would suggest that, yes, maybe the recession won't be that deep, but if you get to profit margins, I think it's a real problem. So a lot of questions to unpack there, Neely, but go back to the first question I asked in this thread, which is, if in fact it's been a structural change in the participation rate, like relative history rhymes, it doesn't repeat itself, but it rhymes. Might the policymakers be making a really big mistake here because they're just, what's the point of growing the economy more from here? It's just going to overheat. I mean, through classical Austrian lens, we're overheating. We run out of labor, ran out of oil. We've overheated. We need a recession. So what would you say to that, Neely? Any part of that?
On those Friday afternoons, I'd say that's some of the math I run in my head is like, oh, what if we're actually 2% unemployment, right? On a real basis, like, what does that actually mean? Because of these dynamics, right, of available labor or willing labor. I don't know, but I would imagine that we're going to have just this widespread kind of reckoning around task automations, right? I mean, no CEO is going to feel good for putting out a press release that says, you know what, we can't actually fill the roles that we want with the people that we need at a rate in which we can afford. So what we're going to do is rethink all of our task flows and cut the fluff out that way. Like, no one's putting out that press release, but people are absolutely having those conversations. you get the manifestation of that, of course, vis-a-vis the kiosks, the ordering kiosks, right, at fast food, right, is kind of, I think, the poster child for that. But I think even in our own business of what we do at Distill, I mean, we have millions of economic data points. And because I'm such a, Luddite, I've basically, for most of my career, I just know how to quickly download the Excel files that I need, and I'm an Excel guru, right? So it's like I can flip stuff around and just do it. We hired this young kid who's still in college who knows Python programming better than anything, right? And he we retain him, and he's automated all of our, through all the government APIs. So we literally instantly sweep across, 6 different agency data sets 3 times a day to make sure we've got the most up-to-date data, right? Best money I have ever spent, okay, is on that task flow. If I'm figuring that out, right, as a co-founder, consultant of a business, paying out of her own pocket, right? I would imagine corporate budgets are going to go down this path too. So do we need all the meetings that we need? Are there things that we can solve with emails and programs? Yes, right? I think we'll just end up having kind of task automations, and those job openings will go away.
Interesting. All right, let's go to Mark Newman, then Jeff Garbaz, then Trent Wizzo. Hey, Mark. Mark, please unmute yourself.
Hey, George, how are you? How's it going, everyone? A bit jammed, but I figured after the second, after George called me out on the Okamoto rubber story, I had to get on the space. By the way, interestingly, I looked at that Okamoto as you mentioned it, George. It's dirt cheap. They just announced a buyback, I think, and it's really interesting. But they produce rubber. I mean, that's got to be a petroleum-based product that's probably going to be under issue. But anyway.
So Newman, are you saying there's going to be a margin squeeze here?
We could go. Look, I can't.
They can't raise. They can't raise prices fast enough.
I don't know. The thing is, I just looked, and on the daily chart, it did break out, George. It looks like it literally just got above the 200 day for the first time, I don't know, in like 3 months, and it's rising. And big one.
I want to hear when you're done. We're gonna have Jeff up to talk about the short interest on Okamoto. Anyway,
right.
So Newman, what's up?
I did want to mention one thing about a stock in Japan that I've always watched, right? 8301, right? This is the Bank of Japan. Okay. If the Fed had a stock, it would trade like this. This is what the BOJ, it never trades. It trades 100 shares a day or something. But this stock, in 07 was 175,000 yen. It's now 26,000 yen. So when I look at this, right, that's sort of the state of the financial industry in Japan. Okay. So it's something to keep an eye on. Just keep it on your radar. 8301 JP. Again, it's the Bank of Japan as it trades. Now, I've been listening, but I've been kind of jammed up, and I'm not going to be able to spend a ton of time. But I was interested to hear what Mr. Hirsch had to say. Sounds very interesting. I think we are at a spot here where there's gnashing teeth everywhere, and everyone's got a sort of different perspective. This morning, I sort of came across the Yardini has one view, Gartman has another view, Robini has another. Everyone's sort of all over the map here. And I think we are in sort of what I'd call like a shell shock moment in the markets. I mean, I wouldn't say yesterday was the shell shock or whatever, but everyone's really having a tough go of this. It's not fun. Other than Tommy Thornton and his magical calls on reversals, which I've never seen much like that in this kind of a tape. I got to think a lot of people getting chopped up and just doing less and not really loving this. Jeff Hirsch made a very important point about earnings season and where we are. There's a ton coming down the pike, right, in the next 2 to 3 weeks. Earnings, the peak of earnings, the Fed. So I think it's a real tough spot here. It's sort of like dip a toe in. If it works, maybe you do more. But if you lose that toe, don't stick another toe in just yet. It's a real tough tape here. And that's kind of what I got. George, I wanted to ask you, a couple months ago we talked about sort of death by sandpaper as opposed to plunge, and I wondered. It feels to me at this point the sandpaper route is probably more favored because everyone's sort of mixed and confused here. I wondered if you saw a catalyst for something that would be more than that, like not death by sandpaper, but death by hacksaw, so to speak.
Well, no, I think you got it totally right. Death by sandpaper is looking like the way it's going to be. But you know what it is, Mark? I mean, Mark, you ask a seemingly simple question, but you know it's impossible to answer. There may well be something out of. I mean, I could enumerate what the risks are. One of these emerging markets blowing up or whatever, but it'll be if something happens, it'll come out of left field. It'll be impossible to identify, and importantly, I mean, it's always a priori. We never able to identify what it is. Okay, and so something could happen. I guess. I mean, when Tommy was talking before about sentiment just being a condition, and when you get low volume, you get sandpaper markets, you got crappy sentiment, the flows. Shrub pointed out we had some money out last week, and we'll get into September, October, and Jeff was going to speak next. I mean, he correctly thought that short term when he was in a week or two ago, market would head up. It did that for a few days, and then all bets off as of last Friday. And he nailed it. But he was only a 5.5, a scale of 1 to 10 being bullish. But was more interesting was what came next. It was beyond that, and I think the drop dead date was the 26th or 27th of July, which is either today or tomorrow. He was on a scale of 1 to 10. He was a 15 on his bearishness. Beyond that, so the higher conviction was that call. But Mark, the way I look at it, I don't know what the catalyst is, but you've been around long enough. When you just see this kind of setup, this sandpaper market with low volume, crappy news, it doesn't take much, and we're never able to figure out what it is going to be ahead of time anyway. So I don't like the setup. I mean, listen, most normal people just be in cash, like Hirsch was saying, go to the beach. If you want to make money shorting, that's fine, but be sure to listen to Thornton telling you when to cover. It's not fun. I think it's the most important thing you said. It's not fun. I mean,
yeah, it's not. I gotta get moving for 1 o'clock, but I wanted to just add my one potential, like it's obviously, as you say, George, bit of an unknown, right? What could be that catalyst? I want everyone to really think about this, and it's a bit of a personal thing because I've made this move to this sort of, that's where I'm going with it. I think this ESG bubble unwind and risk forced by Russia and the energy and foods insecurity. I really think that could be, if I had to pick one thing, it's kind of, that's my leading candidate as a trouble spot, because look, the U.S. government believes we are winning in Ukraine. They also believe a ton of other crazy things. And so you continue to bullshit everyone like that. Sorry for my French there. If you continue that and risks get mapped and become opaque and nobody really knows what they're involved in and why, you get this thing where everyone's like, holy smokes, what is going on here? And I think that to me, if I had to pick one to keep an eye on, it's that. So that's what I got to say. And I got to hop on a call here. I apologize. But George, as always, great place.
Newman, fabulous. Keep it up, man. We'll talk later.
Talk to you guys soon. Bye-bye.
That's great. And with that, we go to my good friend, Mr. Jeff Garbaz. Jeff, how you doing, man?
Hey, good. How are you?
Awesome. What's on your mind?
It's a good thing I don't cover Japanese stocks, so I can avoid having to comment on the condom company. So there you go. Question for Neely, because I love like the thought process and stuff. And one theme that I've paid a lot of attention to over time is the change from the time I graduated from college, which is 1986, to now. When I graduated from college, it was 60% male graduates to 40% women, and now it's completely flipped the other way. So it's 60% women to 40% men. And with this whole idea of the 6% baby births, et cetera, one stock that people want to trash and say, oh, it's going to come to an end. This baby boom thing will propel it forward forever is Lululemon. And the short sellers have been playing in it for a long time. So I'm wondering, A, what does she think about this demographic thing? And isn't that something that basically every consumer company better be thinking about? Because if women are the majority of college graduates, they're the ones that are making the money. They're the ones that are spending it as well. And then secondly, how it plays into Lulu. To me, it just makes it, want to continue. So if she could answer both parts of those, that'd be great.
I can't answer anything stock specific just
Okay.
for the nature of what I do. But
Okay.
but what I
Just
can
the demographic.
yeah,
The
for sure. What I can share with you though is imagine millennial moms and how they might treat their children if they've treated their pet and their plants with such reverence, right? I mean, I think this is
God.
right. I mean, if you want to just like, do you think they're going to put them on the lower,
Yeah.
no, right? I feel badly actually for Fido and for, the tomato plants because they're very likely going to get, kind of stuck to the side as a new prince or princess, enters into the house. So I'm very intrigued by this. And I think the other thing that people just don't really realize is they're like, well, millennials have been around for a while and they've been having, if you look at the population birth rates by year and kind of were to stack up the whole millennial, each annual year of where they are in 2022, the peak of the wave, they're turning 32 this year, so they're really, it's very back end weighted to the span of the age demographic. If it's like, call it 27 to 5 or whatever, like the big bulk of that wave is at about, kind of 27 to 32, not at the 40 to 45. So I think we've been waiting for this for a while, but people have been thinking about millennials monolithically and not actually where the volume, right, of the millennial population actually is. So I think it could really surprise people. But yeah, we're trying to do what we can, talking to boardrooms about this and getting folks prepared for what all the different nuances of a baby boom might be, because we haven't seen it for years.
Hey,
Yeah.
Jeff, just to say, so I was trying to stay away from individual stocks for Neely, but
Okay.
but I got a question for both of you. Same question, but different angle. So we talked before about people increasingly buying what they need to buy, not what they have to buy, not what they want to buy. So Jeff, it's sort of like I'm lobbing the ball into the pivot. I'm giving you just where you want. I know what you're going to do with this. So Jeff, I want you to take the opposite end, the necessities, and talk to me about what the Costco chart looks like in absolute terms, also in relative terms, not just relative to the market, but relative to other retail stocks. And then Neely, I know you can't speak specifically on companies, but maybe just generically, we'll let Jeff go first. Companies that are focusing on necessities, I don't know, grocery stores, maybe grocery stores are getting hit by adverse mix ships, I don't know. But in a general sense, how are companies that are focusing on necessities faring? So, Jeff, first to you, what does Costco look like?
Yeah, let's break them down. Let's call them the need stocks and the want stocks, right? And we now know that obviously from Walmart that that they're basically in the need phase at this point. They can and their want type of person is much different than a Costco person demographically, because it's upper middle class, lower upper class from my sociology classes from college. I still kind of remember that. They look a lot better. I mean, Costco looks a hell of a lot better than like a Walmart does. And then look at today, like one stock just stupidly I stumbled into it for this week that I'm short is KMB, Kimberly Clark. Well, guess why they're getting hit today? Because Walmart's in trouble. And so they're struggling today. So I think, yeah, I've been focusing, George. Like if I look at my our short stuff for this week, it is exactly what you just said. The names that I'm short that kind of fit into that are RH. I'm back with that one again. We talked about that a couple of weeks ago, and it's fallen apart this week. I mean, it's gone from like 270 down to 250 and change. Tractor Supply looks like it's just getting ready to roll over. Kimberly Clark, I think that's a great idea. I think that the need stuff, it could really, they're using it, but you got to define it, I think, by the demographics of it, and then look at the companies that kind of fit into that. That's why I really like Lulu here. I just think that the people that go into a Lulu store are a hell of a lot different person than goes into to Walmart. And I'm lucky that, I have a wife who worked retail her whole life, finished at, Land's End. But I kind of would rather be long at Lulu and then short, like some of these other stuff where they're really struggling, where the margins are much worse. I mean, we heard this from Walmart today. The margins are much, much worse on the need stuff than the want stuff. And that's what's going to kill them. Even though their revenues are going to go up, it's like the wrong mix of business that they're getting right now.
100%. 100%. Neely, could you speak in general terms? I know we don't want to get too granular, but just how need companies are doing compared to want companies?
Well, the one that immediately comes to mind from a sector perspective would be fast casual. And here's why. If you were to look at home ownership in the United States under the age of 35, okay, you would basically see that from 2006 to 2016, we saw just constant headwind of declines in that home ownership rate. Okay, like it was not lovely. That it provided the fodder that millennials would never own a home during that whole the 10 years of that. But if you think about who grew from 2006 to 2016, right? It's the rise of the fast casual, the $5 coffees, the $10 burritos, the $20 salads, right? Like that is who really benefited. And, as that reverses, and you can actually go back and look at this, George, I would recommend, you could actually go back and look at this from an inverse relationship. There's a pretty decent inverse relationship between home ownership under the age of 35 and just restaurant spending and retail sales broadly. So, we're just kind of waiting for that shoe to drop, I suppose. And but I don't really track those stocks or what have you. But from a category perspective,
I mean, Neely, I'm showing my age now. I'm sorry, but I was having a conversation the other day with somebody about a young person who was in their late 20s, trying to make ends meet. They've got student loans, et cetera, et cetera. And, I want to be empathetic, but when we were growing up, okay, even adjust for inflation, if someone said to you, this is before Starbucks, someone said to you, hey, you know what? Go out and spend $5 or $6 on a coffee. I couldn't believe it again. It was a Cape May. The money people are spending on stupid shit like that, like it may not sound like much, but who in their right mind amongst us that are older would have thought spending this type of money on coffee? Like it's just stupid. And there's all that's a function of you said the home ownership went down, but also the excess we lived in was a great moderation. Pricing power went up, blah, 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 blah. But $6 coffee, that's not a need. It's a want. And there's a lot of crap like that. I mean, so I don't know. I mean, am I being too harsh here, Neely?
No, not at all. I think we're arguing the same. I mean, the thing I like to joke about with clients occasionally is like, what's the first thing you buy the day you sign your life away on a mortgage? It's not a $5,000 cruise, right? Like that's not what you're doing that day. Like everything we have thought about millennial behavior prior to home ownership, prior to having children, literally needs to get scrapped and relearned.
100%, Neely. 100.
Yes.
This experience crap. It's like no price is too high to pay for cheap thrills, whatever it might be. 100%. 100%. Or take food delivery companies where all this bullshit. Going out to eat. Hey, how about cooking some food? It is I don't know about you, Neely, but like you go out to eat now. I don't live that high money, but a restaurant, which a couple of years ago you might go out, a couple entrees, maybe a couple appetizers, a couple glasses of wine. I don't know, $80, $90, whatever. I'm just talking out of my hat, $70. Let's call it 80. You go out now, it's like 120, 130. I'm like, are you crazy? It's not that I can't afford it. It's like it's against my. I can't in good conscience spend that kind of money. It's ridiculous.
I put the gal in frugal. Okay, I just want to put that out there. I still drive to this day My first big girl purchase. It's a 2004 Audi A4 6-speed manual transmission. Won't ever get carjacked in the city with this thing, right? Like, I love this car. I love that it's rusty. I have no problem with that whatsoever. Like, I put the gal in frugal.
Love it, Neely. Absolutely love it. Hey, Jeff, what
Hey,
you got to
George.
say?
Yeah. I was going to just say that anecdotally, I'm like disguised in the millennial age group because we didn't have our boy Max until I was 45, and now he's 12 years old, and as you know, he's a big swimmer, and so we're at all these events all the time. We're going to dinners, and all the millennial people, all the people that are Max's buddies' parents are mostly, I'd call it late 30s to maybe some early 40s. Every once in a while, there's someone who's my age. But yeah, you're right about the spending thing. It's incredible. I mean, we just had it this weekend where we had to go to dinner 3 nights after 3 days in a row of the state meet and different dinners. And like, I'm like, this is freaking stupid what we're paying for dinner. Like basically 3 of us, it's like $140. It's just like a decent restaurant. It's just the inflation in the restaurant side is amazing. But the point back on the millennials, which Neely said was, and the one thing she did say about it is they're the most educated generation of that's out there. Like they blow away everyone else educationally, and so they'll figure that out. And then, like the consumer is not dead by any stretch, thanks to them and what they're going to do. And I agree. I see how kids get treated, like with swim and having to buy like the thing is under 12, you can't buy a tech suit, but they get as close as they can, and they'll spend as much money as they need to, and they'll spend as much money, going to a $1,000 swim camp, George, for 4 days. And yeah, the consumer is not dead. Thank you very much to the millennials. It's going to come back.
It's great stuff, Jeff. Just hang there. Let's go. I want to do Trend Wizzo, and then Weimar. Hey, Trend Wizzo, good to hear from you. What's going on, man? Trend Wizzo, please unmute yourself.
Yeah. Hey, George. Thank you. Great forum. Neely, one question for you. This is based on just my experience. What you shared is the precise data that went into one of the investments I'd made about 4 years ago with the folks in. Just hang on one second. There's a background noise. I need to mute. Yeah. So I'd made an angel investment in a startup firm with some ex-Amazonians and ex-Facebook folks. They were optimizing these digital ads for vendors, third-party sellers who were selling on Amazon. And they got an exit last year just before the carnage started at about 30 times ARR, which is pretty cool because 8 of my other angel investments went straight to zero. This was the 9th one, which gave more than 100 bagger. But there are generational businesses which are focused on this millennial mom kind of target audience, and they're trying to build brand aggregator kind of firms focused on that. So 2 questions from that, Neely, and also for Jeff and George. From your perspective, you must have seen these kind of generational changes earlier as well, right? Based upon your experience and based upon your study of the history. From my standpoint, I have done the study just primarily based upon my experience. I'm in my 40s, and I've also read what Neil Harvey and Strauss and those guys have come up with, their 4 turnings and those sort of theses, and which, so far they built that thesis back in the 90s, and so far it has been turning out the same way. So two aspects. Thematically speaking, which specific areas other than consumer discretionary would be primarily important from your standpoint as a thematic investment, let's say on the other side of this market, right? So currently it's a market to go short, short or flat, as George keeps saying. But on the other side, where would you focus on? And second part is purely from financial services, from this demographic kind of situation. One, there's a lot of inheritance that is going to happen. How does it change your business? This is specifically for Neely.
Would you be willing just to reword that second question for me, please?
Yeah, sure. So from financial services perspective, right, how does it impact as generational wealth gets transferred, and also as we head into the 4th turning, as well as the millennial generation starting either to plan for their finances versus handing it down to the next generation as we go along for the next 10 years. So in the next decade.
I'll answer that with a perspective, not a proclamation. I'm not in the camp that believes that we're going to have the transfer of wealth that financial advisors constantly are out there with. Most for the primary reason that I think a lot of it will either get invested early into their children's lives. Like, I think that you are seeing parents actually help out with big purchases like homes and what have you, or investments in private education for, children. Like, I think it's going to be invested and transferred possibly like during life. And then, of course, the cost of healthcare and end of life care is so substantial. One thing I would have you poke around on, and it's not something I've been able to solve specifically, otherwise I'd have a chart and I'd be able to put it up in the nest for you. But it's a hypothesis that the way that we do end of care or end of life care housing, right? Now more than ever, you basically have to show like your full like asset portfolio to get in on any of those places. And they kind of you basically end up transferring ownership, a lot of your home equity, what have you, to those facilities. So something I would just have you poke around on is like, where's the seepage of that transfer of wealth prior to death, and then actually at the point of transference of death. So that would be one thing I would have you poke around. But we're not in that camp. We would not actually hold that. And then on the just broader discretionary categories, I think we could all like sit here and go, baby related stocks or, parenting related stocks or, apparel related. I mean, kids bodies change as they're growing. Like, they need multiple sizes in purchase incidences per year, right? As they age from 0 to 16, like your body physically changes multiple times per year. So there's things like that, that you could kind of obviously think through and think about. But, I don't think I'm especially qualified to answer that. Right. But thanks for the question.
Thanks for that. Let's go to Weimar. Weimar, good to see you. What's up, man?
Hey there. So kind of one comment and then maybe a question. So first thing on the 16 to 19-year-olds, and I messaged Neely about this. One of the things I've come to realize is talking to some coworkers, and I followed up after I talked to one. A lot of them now don't work because they're busy doing extracurricular activities and internships to get into college. They're singularly focused on that, getting into the right college. So I think that's actually depleted a lot of the workforce out there. And that's something you'll see kind of with your theory about the doting parents and grandparents. A lot of that is really geared toward, getting them the right start to get into the right college, to get the right job eventually. And then my second point and really question is, how do you think the unemployment's really going to play out here? And I have a bit of a thesis that 2000 to 2001 might be the relevant recession to compare it to, where we actually saw unemployment go up a bit over 2% from, I think it was around 4.39 to about 6.3% it topped out at. It took a bit over a year to achieve that. But I'm sort of basing that on the fact that typically unemployment, at least in the theory of John Maynard Keynes, was a reaction to, or an attempt to cause deflation in labor prices, because in his construct, labor prices are sticky, they don't fall. So you lay people off to achieve deflation there. Well, we just came through 2 years of very high inflation, probably far higher than they stated, and real wages have mostly fallen, particularly for the middle and probably higher end of the spectrum. So I wonder if anyone out there thinks inflation will be quite a bit, or unemployment will stay quite a bit lower than in maybe the prior 2 recessions. So
yeah, I think Weimar, I think I touched on that a little while ago. That's my belief. It's going to be because there's not as much labor participation rate, as Neely was explaining, has gone down, and we have a record number of unfilled jobs, and companies I think are going to hoard labor because of lack of labor supply. I don't know, Neely, do you have a view? Neely?
Well, first I just want to say I can't help but say Weimar because I took German for 8 years. Okay, so there you go. Weimar. I I I 100% agree with you on that point that you were making about the 16 and 19 getting repurposed, right, for other opportunities. And interestingly, I think I have to go back and confirm this, but I want to say like there's like this great old chart that exists around like the number of people employed um, with college degree versus not college degree, like every once in a while you'll see that kind of floated around. I think it was around 2000 where that started to flip. And so it just became far more competitive too, right, for the college systems, which makes sense too with just the rise of the millennial population. More, it's supply and demand, more people, fewer spots, which is also why the price of college went up. That and the government deciding to give funding to everybody. So there's that. So yes, all of that above. But in terms of the unemployment, I don't know. I mean, I don't know how that's going to play out. I do think though that we'll see two things happen first. I think you will start to see job openings pull back. You already see it, by the way, in manufacturing. So if you look at typically you'll have most of the media sources quote 13 different industries on any of the jobs data, right? JOLTS data. I think there's about 28 that you can actually look down into specifically. The manufacturing component of job openings, it's still a growth rate year over year, but that growth rate, the second derivative, has just come in substantially from its peak in February. So, which kind of fits the broader narrative of like manufacturing new orders pulling back before other aspects of the economy. So I think you're already starting to see that as a leading indicator. And the second thing, of course, is jobless claims, something we track prolifically. It's a high frequency data set, right? Of course, but we're looking at it relative to 3 years ago, not on a year over year basis, because you kind of want to get it based versus kind of a normal sort of period. There's a lot of monkey business in the last couple of years on jobless claims. And you are starting to see that tick up again. So on that basis, so those would be the two things you would see as a leading indicator before we'd have to know that answer.
Thanks for the question, Weimar. That was great. All right, we got two more questioners, and I think we're going to call it a day. We're going to go to OVO, and then we're going to go to Andrew. OVO, the floor is yours.
Thanks, George. Hi, Neely. Quick question on the urbanization or de-urbanization trend we've seen since COVID. Just wondering, urbanization ratio is typically a good way to measure prosperity of an economy. I think William Bernstein talked about this in one of the books I read of his. What do you see in terms of consumer trends as people have moved out of cities, and how do you think that, impacts the economy, maybe on a, 5-year look forward basis?
That's such a great question. I don't know. George, do you have a perspective, or does anyone else on the panel have a perspective about that? That's a great question. And OVO, I really appreciate our banter in the back channel too, by the way. It's good stuff.
Awesome.
I have no idea.
I would imagine it's going to be hard to have that question without like having a political conversation too. I live in the Twin Cities, and the carjacking comment is not a throwaway comment. Like it's literally every day. There's just carjackings and robberies every day in the middle of the Midwest, Minnesota. So, I think the cities aren't doing themselves any favors right now of being an attractive place to live.
Hopefully we'll have that was a great question, OVO. Hopefully we'll come up with a better answer in one of the subsequent rooms. All right, let's go to Andrew for the last question. Andrew, please unmute yourself.
Oh, hey, George, thanks. I just had a quick question regarding the resilience of like a Cisco, going back to those restaurant comments. I've expected them to roll over a little bit. And REITs, the REITs, everybody's seemingly hiding out in them. And I figured with the rates going up, they're gonna crack soon. But I guess the strong net leases are where people are parking some money.
You know what? Let's turn to Jeff Arbaz. Jeff, if you're still there, could you just comment on Cisco, the stock, the food distributor guy, not the router guy, and also on REITs? Are you there, Jeff? I guess not.
Hey, George, I'm here.
Yeah, so there were two questions. One was on Cisco, the food company, SYS, not the router guy. And the other one was on REITs. What are the charts? What does your work suggest on Cisco and on REITs?
I can answer half of it. I'm pretty sure Cisco is just kind of like it's okay, not great in Newark. I stepped out to grab some lunch, but I know on the REITs, the real estate stuff is definitely kind of struggling in our work a little bit now. When I was looking for short ideas, I almost put some of them on this week. So that's kind of what my thought is.
I would just say
they're not heavily shorted.
Yeah.
The one thing I'll say, real estate related though, you and I talked about this yesterday, is the shorting in the home builders is out of control. And they've had a rally here, and it doesn't look like they're covering. So for what it's worth, I think that is something I want to watch and kind of see how it goes, especially because of how those numbers are going up so dramatically. So I think that you're going to learn a lot about real estate by following the home builders now. George, you kind of agree with that?
100%. I'll just take it one step further. On the REIT side, and Andrew, I know REIT favors, but a couple weeks ago, it was estimated. Jeff, I'm muting you because there's some background noise. The birds are chirping. There's a paper that came out where they guesstimated that New York real estate, I think it suffered order of magnitude a decline of $500 billion. $500 billion. And whether it's too high or too low, who knows? Order of magnitude is what's important. And that's not unique to New York. And so I think you were talking before about, sticky leases and whatever. It's clear, and Neely, this goes back to a sort of demographic question. We're rejiggering, the demographic map of the United States, where we work, where we live, where we play. And there are winners and losers here. For every person that runs to Florida, that's one less person in New York. Sorry. So I think reshuffling the deck here is going to be a lot of winners and losers. And Andrew, to your question about REITs, I would avoid the office sector like a plague. They may be melting ice cubes. It may not happen all at once. Depends on the term of their debt. But I think office real estate's a disaster. Housing, I think, is a disaster. I wouldn't own anything real estate related. Yeah, okay, fine, I get it. Rates coming down, blah blah blah. Okay, fine, but underlying businesses falling apart. And by the way, for everyone talks about industrial REITs and all that other stuff, there's been a lot of tweets out the last couple of days. Gordon Johnson put out a terrific tweet. Follow him at Gordon Johnson. A great thread chronicling the tech sector slamming the brakes on their real estate aspirations, whether it's the number of warehouses Amazon's hiring out for, or Walmart, or this or that. So they're slamming on the brakes. And so I think office is a disaster. I think industrial is questionable. I think housing is terrible. I just think REITs are a waste of time. I really do. Would I short them? I haven't done enough work. But some of these things are going to go out of business. There's no question. Just may take a long time because of the term of the debt. All right. With that, ladies and gentlemen, we're almost at 2.5 hours. I try to keep this under 2 hours, but it's supposed to be such an interesting room. And Neely, I blame you, or give you the credit for taking the reins from Mr. Hirsch after he left. This has just been phenomenal. And Jeff, thank you for your input as well. Mr. Thornton is not here anymore, but he was terrific. It's a great room as always. Our next room is on Thursday morning at 11 a.m. Eastern. We have another terrific guest, Danny Moses, will be with us. That's going to be an awesome room.
Hey, George.
Yes.
Real quick.
Yes.
Make the kids work. I'm sorry. I tried to lay low, but I heard the kids talking about your kids and teenage kids. We did it 19 years ago. Kids cried. We moved to a small town. Both my kids worked, and they did the sports and they did the academics, got in college, got scholarships. But we made them work at a pharmacy and a bank. And they had to talk to people that weren't like 17 in their little circle. And it worked out beautifully. Both of their careers, they could talk to a 60-year-old, they can talk to a 50-year-old. And they didn't like it at first. But later on, when they were out in the workforce about 8 years ago, they got compliments in the interview process. In the first year, they said, you can talk to people. And put them in a situation where they have to deal with old man Mr. Johnson, who's pissed off about his were wrong, or the bank deposit bank teller where, well, I don't understand this, and they got to help people anyway. I know I'm being like the old man giving advice, but that's my 2 cents, and I'm sorry to interrupt.
No, Carpathia, that's fine. I forgot I invited you up to speak. You snuck in there, but thank you for that contribution. No, you're speaking the truth. You're speaking the truth, and whether it's working when you're 17 as a teenager or learning the ropes in the stock market and not getting blown up chasing meme stocks or listening to false prophets like Kathy Wood, everyone's going to get an education. No shortcuts. You know that, and I know that. And thank you for that. I appreciate it. So, in any event, so we're going to have Danny Moses on Thursday morning, 11 a.m. Eastern. Should be a great room. And who knows what's going to happen. We get a lot of tech earnings, a lot of earnings this week. So, I'm sure I'll have plenty more to talk about. I want to thank you, Neely. Thank you, Jeff. Thank you for Carpathia, Weimar, Tommy, et cetera, et cetera. It's been a great room. And I'll see all of you on Thursday at 11 a.m. Thanks very much. Take care. Bye-bye.